Hi everyone, my name is Tabitha and welcome to my YouTube channel. If you're new to this channel, please subscribe and enjoy more of our conversation. And today we are going to talk about simple interest uh, and compound interest and why are they important when it comes to borrowing or investing. We have simple and compound interest. Simple interests are calculated on the principal, like the original amount that you borrow, and compound interests are calculated on the principal plus the accumulated interest from the previous month or years. So that makes the difference. How to calculate simple interest? So interest paid will be principal times the rate times the time in years. So principal amount is that amount that the bank give you or whoever is lending you the money. And then the rate is the percentage that they charge on it. It could be 10%, 5%. Time in years could be in month, and then you convert it in years. So let's see, for example, a company or individual can borrow 1,000 at a rate of 5% for 6 months and sign a note. So this will be a note payable, and you have a 5% on that 1,000. They will make 5% of 1,000 in 6 months if you don't pay it on time. So here, this is the formula on how to calculate the simple interest. So you get the 1,000 times the rate times the time in years, which is 6/12. You get 25 as interest. But this interest on the side of finance, you will only pay it if you wait until that the last minute, like June 30th. And then you will have to pay it. But if you take the money today and somehow you are able to pay it tomorrow, and then the bank will not charge you that interest because you haven't like taken long to pay it off. Journal entry when money is borrowed. So at that time when you get the money, how to the company that is borrowing the money record it, or if you record your things as individual or borrow, so you can see how it will look like. So you will have a cash of 1,000 into your pocket, and you have a note payable that mean you have to pay that note payable after 6 months. Or if you paid in January 2nd, and then the bank will not charge you any interest, and they will you will erase your note payable on your record. Let's see. What about when the money is being paid now? Let's say, for example, you were doing a business and you didn't have that cash at hand, and you end up like waiting until June the 30th. So here you will have to pay on your record, because not payable is a liability, and when the liability is reduced, you are reducing it, you are paying it off, so it will be a debit. And then interest expenses, so you have to record your interest expenses, which is 25. When expenses increase, you debit them. And then the cash that is leaving your record as a company will be 1,025. So that the cash, even for individual too, that the cash that is leaving the bank when they're paying off that debt after 6 months, so you lose 25 to the bank, or maybe whatever, depending on what you were using the money for. Maybe it has given you more money, so I don't know, depend. So journal entry when note payable is repaid, that's how it looks like. So you have the interest, you have the note payable, and you have the cash that is leaving the thing. So your record will show as a company that you have paid off your note payable, and you have incur interest expense of 25, and the cash that has left the bank is 10,000, no, $1,025. So what are some of the loans that have simple interest, and why is it important for individual to know? Is like the car loans. Car loans do have simple interest. Retail installment loans, they also have simple interest. So as an individual, when you go to the bank and then you want to borrow money, so you need to know what is this interest on your car loan or the installment loan that you're taking. Is it simple interest or compound interest? And when you're borrowing money, it's very advisable to have the money that you're borrowing has a simple interest, because it's like they only charge you on the principal, not not with the accumulated interest. Or some mortgages too, they do some simple interest. Compound interest is the accumulated. You calculate the interest on the calculated on the principal plus the previous amount of accumulated interest, and it's compounded annually. So which means the bank will benefit if you are borrowing money, right? Because like if you don't pay last month, your their interest will hand them more interest from you. So let's see how it works. So 2 years of 3,000 loan, 10% interest compounded annually. And year one, this is how it will look like. You have an interest of 1,000. You will take principal times 0.1 times 1, which give you 300. So they will make 300 interest on the first year. What about the second year? If you have that long-term loan that you're not paying off soon, so what they will do is, like in the second year, the new principal will be 3,000 plus the interest from last year, which give them 3,300. So they will charge you interest on 3,300, which make it different from the simple interest. If it was simple interest, regardless of the years that you keep the loan, they will keep charging you on only 3,000. But for this one, they have to add in the interest on top of it. So here now in the second year, you're paying 330 as interest. So you see how it looks like. So they're making more money off you for keeping that loan that has compound interest. So as you borrow, you have to borrow the one with the simple interest, because that's what really is good for individual. The loan that have credit cards has compound interest. So if you really want to not lose money too much to the banks, and then you use your credit card paid off on time, or use other alternative of borrowing that have simple interest, like personal loans, sometimes they have simple interest. A line of credit have simple interest. Student loans have compound interest, because they don't want you to get ahead, so they will keep compounding that interest every year, every year, every year.